Now, in some company news, Old Mutual shares soared over 11% this week after news emerged that it will be restructuring its operations. Now, the company did announce its results in London, will announce its results tomorrow in London, as well as give details of its restructuring plan. Of course, Old Mutual was started in South Africa back in 1845. It became a public company in 1999 with listings on the JSE in London and, of course, in the US. Now, there is widespread speculation that the company will be split and, of course, sold off. Now, let's find out more about the firm's planned restructuring. We're now joined live in the studio by Shiv Arora. He's the head of private equity and real estate at Citon Investments. Shiv, welcome to the show. Now, this, of course, is a firm which has been consistently profitable. What is behind the decision to split it into more parts, and how will this, of course, change the company's valuation?
Hi, Uche. So there's a couple of things that they're probably mulling over as they consider this split. And there's three key factors which they've been considering. The first is that Old Mutual right now as a conglomerate is trading at about a 25% discount to its peers in South Africa, the United Kingdom, and the United States. So for management of the company, they're really looking at optimizing the valuation of the firm. And one of those ways to do it would be to split off every single business unit into the four parts which they're thinking about so that they can optimize the sale price. The second is, it's actually very interesting. They make 68% of all their revenues in South African rand. However, they pay dividends and returns back to their shareholders in England in pound. And we've all seen what's happened with the South African rand over the last couple of years. Actually, it's been very volatile, and at the moment it's really depreciated. So they're really suffering on that front as well in terms of actually returning value to their shareholders. And the third reason we're really seeing is that in the United Kingdom now, especially with their Old Mutual wealth management, the pension laws are changing, savings laws are changing, where those who are retiring now have more control over their pensions. And that's causing them not to be able to remit any sort of capital back towards the United Kingdom from South Africa. It's really affecting their solvency and liquidity ratios as well, which is making it difficult for them to keep operating in the African markets.
Now, like you mentioned, Old Mutual is actually breaking up into four different firms. Now, how do you see this alleged $12.8 billion breakup taking place? Take me through it.
Well, the first would obviously be the easiest one to do would be the United States, Old Mutual Asset Management. It's listed on the New York Stock Exchange with about 212 billion US dollars of assets under management. That spin-off would be easy, just on the exchange, valued at about $1 billion US dollars. The second one, which would probably be not that difficult for them to do, would be their UK wealth management distribution platform as well. It's been accumulated over time through a number of acquisitions, and for them it would not be difficult to spin that off, especially looking at it from a Citon and a private equity perspective. You'd be very interested in it given the changing laws on pensions in the United Kingdom. And then third would probably be the best one. It would leave the Africa business for Nedbank and Old Mutual Financial Services to run by itself. We've seen it happening with Barclays, where the parent company wants to actually exit from African operations. So the split would largely be into three: the US, UK, and as well into the African businesses.
Well, thank you so much, Shiv, for those insights. Of course, Shiv Arora from Citon Investment.